The markets are fake. Everything's a scam. You hear people over and over and over talking about how we live in make-believe land when it comes to the stock market. Well, let me tell you, regardless of what they say, if I can track it, I can trade it. That's the way I look at it. And the beautiful thing is now you can still do that when it comes to our large charts. We talked about Ned Davis research and the report they had that based upon the quant trading, based upon the algorithms, based upon the dark pools and all the other stuff that goes on. Day trading may be a thing of the past, and there's still people who say that they can do it, but when we look at what we do here, regardless of the computers, regardless of the automation, when we look at nice, clean charts, we look at weekly vertical crossovers. You can look back in time and see how over and over and over again you can count on the charts. Now, is it perfect every single time? No, that's what makes it exciting. But we can track what's going on in the markets. Now, there's some stocks and ETFs that move too quickly, don't move in any certain order, and you cannot chart those. But you can chart the S&P 500. You can chart the NASDAQ 100. You can chart bonds, and you can darn sure chart gold. So that's what we train for. And, of course, game day is going to be the next market crash, when we know when to get out of the market, and then we can either wait for it to go down and bottom out, or write it down with inverse funds or other things that go up when the market goes down. That's what we're training for, folks. This is not rocket science. It is stock charting, and we want you to be with us every day, 10 minutes. That's all we ask. Keep it simple and straightforward. That's what we do. Markets are all down today, everything from stock indexes to bonds and gold, biggest down. We'll talk about that in just a minute. Let's jump first into the S&P 500. We still have a weekly up candle in the S&P. We see that the price percent oscillator is heading up still. Derivative oscillator is flat, drawing a candle a little bit above the prior week's. Price movement is right there at the 2-day trend line on the weekly chart and above the weekly trend line quite nicely. And again, that's where the weekly chart is, so that's our big wave. Let's go to our intermediate wave next. That's the 2-day chart, just barely above the 2-day trend line as far as price movement goes. Derivative oscillator gaining upward momentum. Price percent oscillator is just barely moving up, keeping pace with the red signal line. So again, we have both our 2-day and our weekly in confirmed up moves, which means we can be looking at the appropriate point for a jumping in point if we have the 4-hour chart crossover going up, which it is not doing yet. It's still above the 2-day trend line. We had up movement in the morning, bit of a pullback in the afternoon, ended the day with indecision tending down with that spinning top, almost a doji. Derivative oscillators about flat. Like we said, price percent oscillators heading down, so the pullback is underway. If things rotate around and the 4-hour chart crosses over before the 2-day moves in the wrong direction, right now it's still confirmed up along with the weekly. This 4-hour chart crosses over going up, my friends, you have a jumping in point to do a practice trade on the S&P for more upward movement. Now you might say, wow, Tom, it is long in the tooth, isn't it, since we had our last weekly vertical crossover? Well, it goes all the way back to late January, but look at what the market's done. It's continued to track up. It's had a couple of blow-off points, but again, it's continued to move up, and we've had some beautiful trades as that has occurred. So we'll continue to keep our eye on things. If it makes an opportunity for us, we are trend followers. What will we do? We will follow that trend. Okay, and again, down for the day just a little bit, 0.03% on the S&P 500. NASDAQ 100 down a little more, 0.24%, so just about 0.25%. We look at that weekly chart, still heading up. Price percent oscillator heading up. Derivative oscillator gaining upward momentum. We have a decent green candle, higher than the prior week's candle, even higher than the wick on top. Price is just below the 2-day trend line, above the weekly. Well, no, crossing right there at it, so it's staying on there on the weekly chart. We go to the 2-day. What do we see there? Still heading up a little bit, and again, price is pushing a little higher, so that's good. We just ended the latest 2-day candle, and again, continuing to move up. So you know what? We're going to make sure we draw that trend line. There we go. Somehow that trend line got knocked off a little bit, but yeah, that's looking all right. Price movements above the 2-day, well above the weekly. Derivative oscillator gaining a little bit more upward momentum. Look at that 4-hour chart, and of course, those who've been watching it, we saw it move over in the morning, and move up in the morning, move over in the afternoon. And again, what it's really doing, tracking sideways mostly. What is happening with the Qs? Don't really know. Like we said, down about 0.25%, closed at about 185.03. And again, we'll continue to keep an eye on things. Derivative oscillators gaining upward momentum. Price percent oscillators heading down. Now again, you use your 4-hour chart to jump in. You don't jump out necessarily just because the 4-hour chart crosses over going down. We told you yesterday, you've made a nice profit in less than 2 weeks. If you wanted to take that, you can feel free. You could have, as we said, taken it this morning and done fine in that trade. In fact, the high during the morning, somewhere around 185.78, something like that. Not bad for a jumping in point around 180, 181. So not and just over the course of a few days. But what do we do once we get in? Does the 4-hour chart cause us to jump out? No, not necessarily. 2-day chart is still heading up, as is the weekly. So again, just nice continued up movement. If things pound down on Friday and you're still in, of course you could pull it then, but could just be digesting its gains, getting ready to pop up again. We'll just continue to watch, keep our eye on things, see how they go. If you are in a trade, want to know what your reason is for getting out, you always want to have a reason. Sometimes, you know, your reasons I like are finding previous highs, which again would have been right around where it popped up during the morning. You could have set yourself a nice ceiling around the 185.20 mark or so. You could have even kept it a little bit lower around the 184.20 mark, depending on where you wanted to mark that. Maybe where things crossed over going down the last time, which again have been around the 184.70 mark or so. You can make up your mind to do whatever you want to do with your own money, setting parameters. We've talked about how you can make your determinations on to when to get in. That's typically on a 4-hour trigger, and much more discretion on when to get out. How much profit are you going to be happy with, and where are you going to find stopping points for up movement in the market? All of those things are worth you practicing. Okay, let's keep moving through these charts. We're going to go to TLT, 20-year bonds. We have a red candle that's forming, wick on top and the bottom, trying to push through that weekly trend line, down 0.59%. Price percent oscillators headed down. Derivative oscillator is still positive, as is the price percent oscillator. We go from the weekly to the 2-day. And of course, we now have a confirmed crossover going down on 20-year bonds, which of course makes it much more difficult to jump into any trade at this point in time. Derivative oscillator gaining downward momentum. Price percent oscillator confirmed crossover going down. So that is where we are on bonds. We'll just continue to watch and see what we see on the bonds, but they are confirmed crossing over, going down. So we're changing our arrow, and of course we're changing our crossover blue line. So that's where we are on bonds. We go to the 4-hour chart, and of course we're hoping it might rotate over and go up. What it did is it did go up for 2.5 days and then dropped over this morning, continuing to head down. So we'll see how bonds sort themselves out. Pay attention to bonds always in relation to what they can tell you about the market. Whether bonds are doing strong, typically when bonds are doing super well, the market, that is the stock market, is having some problems. When bonds aren't doing so well, usually portends the market is going to do better. Why? Because bonds are typically a safe haven for money when the market's not doing well. And if the market recognizes bad things are coming, you might see more money move that way. Lastly, as always, we go to gold. Gold down 1.28% for the day. What do we see going on this week? Well, we're down to a doji right now with one more day of movement in the market. Derivative oscillators gaining downward momentum. Price percent oscillator now heading down at the same angle it was the prior week after that weekly vertical crossover for the week ending the 29th of March. So again, we'll continue to watch and see what we see in gold on Friday, down 1.28%. What's the two-day chart doing? Of course, the two-day chart had been heading up at the prior two-day candle ending on Tuesday. This latest one, we've got a really wacky looking candle, one we haven't seen in quite a while. It is a red open box spinning top. Now, solid red typically means much more down movement that we see there. What we see here is lots of indecision, big wick on the top, a smaller wick on the bottom. So again, not all upward movement is lost on that two-day chart. It's reflecting the big down day on Thursday with an up day previously. So that's why we're seeing all these wicks on both sides. The price percent oscillator heading down now. Derivative oscillators flat. Of course, price percent oscillators in the negative. What do we see on that 4-hour chart? Trying to cross over, going down. Of course, crossed over going up back on the 5th. And we'll just continue to watch and see what we see with this 4 hours. Is it going to cross over going down and give us a jumping in point? Here's the only concern that we have, and we've talked about this the entire time. I'm going to actually go back to the two-day chart to talk to you about that. We look at the hard bottom. I was talking with one of our Patreon members today on their 15-minute once-a-month telephone call. It actually ended up being a good bit longer than that. We had a very interesting conversation. I was talking about gold because they mentioned it. And of course, we see the 200-period moving average line on the two-day chart being a floor. And of course, we've had gold bounce off that floor of 121 several times. If you look at the chart, something we always want to look for. People ask me, why do you have the 200 and the 50-period moving average lines on your charts for just this thing? And of course, we see where that has been a hard bottom. Now, if gold rotates back over going down on that 4-hour chart and starts to go down again, continue to watch and see if it's going to pierce this $120, right at, 121, forgive me. I hope I said 121. If it's going to pierce that $121 mark. If it pierces that, it can, of course, drop a long way down before it hits the purple, what we sort of call our hard bottom for gold that we've seen in the past. So we'll see. If gold does that, then by all means, know that, pay attention to that. And if you're shorting gold in a practice trade, well, that might portend very well for you. But just keep your eye on the prize. Folks, that's where we are as we end the day on Thursday, going to the last trading day of the week. We so appreciate you being with us every day. We know we've had some trouble with the email going out, the daily market reviews going out from the website this week. Many of you have not been receiving those. We had some kind of malfunction with the email service, and hopefully my programmers have gotten that resolved for us. They were having quite a time figuring out where the problem was with all the different applications that we use, but I hope they've gotten it fixed now. Hope you're seeing it. If you are not receiving your information, don't forget show notes are always published at the website chartingwealth.com, and of course you can always listen and watch on YouTube and iTunes. And if you're not a subscriber at YouTube, please go there and subscribe. Even if you get the daily email, your subscription helps us with the metrics. Same with iTunes. We appreciate you being a subscriber. And if you haven't purchased the book, hey, 9th printing showing up tomorrow. We will be sending out all of those books and orders. If you live overseas, just email us, cw@chartingwealth.com. We'll send you a PayPal invoice. If you're in the States, then by all means, just follow the link in the show notes. And you, again, can find those show notes in your daily market email. You can find show notes at our YouTube channel underneath the video. You can find show notes there at chartingwealth.com with the daily reviews and the comprehensive review and forecast. Of course, we're going to be recording that after the show on Friday. So thank you so much for being with us. You have questions, problems, concerns, feel free to write us, cw@chartingwealth.com. Buy the book and be a Patreon supporter. We've had several new people sign up lately, and we so appreciate that special support. God bless, my friends. All the best from the whole team here at Charting Wealth World Headquarters.